Welcome, everybody, to another episode of the Business Barbershop Podcast. I'm Chris.
I'm Keen.
And I am Andrew.
It is that time of the month. We are live in studio, really just in my office. And it is April 1st, day one of Q2. Hopefully, everybody had a great Q1. Actually, had a pretty good quarter. And we are here to talk about who knows what, all kinds of randomness. So, Keen wants to talk about the market, so maybe we'll just start there. Maybe we'll talk about some goal setting, which is something I always like to do.
Oh yeah.
And then who knows? So,
Well, there's a lot to talk about in the market.
let's go.
The entire sector, I mean, the whole market's came down. The stock market's down quite a bit. And
Significantly.
Yeah, and me being the investor I am, I'm just like combing through the companies being like, who is way cheaper than they should be. And I know who.
There's a very large basket of companies that are way cheaper than they should be.
Yeah, okay, that makes me very excited. I have two goals. I want to talk about the market, talk about the companies that are heavily discounted. That makes me very excited. And one of my other goals, and it may not happen on this show, is I want Andrew to talk a little more like he's not on a microphone.
Well, he has by the way, as we start this off, just a blanket disclaimer for all you people out there.
Yeah.
Although we may be financial geniuses in real life on this podcast, we are here for entertainment purposes only. So do not take our advice. Do not act on our advice. Do not blame us if you do something and it doesn't work, because it's not our fault.
Yeah, we'll
All
just
right?
say it's not advice.
That's right. This is not financial advice. This is for entertainment purposes only. This is not legal advice. This is not any kind of advice, actually. Okay, so we have. I think we've made our disclaimer, and now
We're giving our
can
opinions for
proceed.
entertainment.
Yeah. Well, okay. So if I was going to start at the top, which is where I always prefer, I like to zoom out first and say the optics of what's happening in the market are a little skewed in my view, because let's just compare it to the most recent decline. 2022. The S&P was down 20%,
Yep.
and the NASDAQ was down 30%.
So in 2022, what was the big event that was pushing it down? Was it the regional banking?
Well, we were starting to feel the effects of inflation and a pinch on budget, and it was 2 years post COVID, and so
Was that the year that Silicon Valley Bank broke?
The lockdowns
was it
were still in
23?
effect
What
in
broke?
major metropolitan markets.
Maybe it was a year early when the beginning of the bank failures began. Silicon Valley Bank was it 23. Maybe it's 23.
I think it was, but that was just a blip, though.
Yeah.
Yeah, but ironically, those bank failures in total asset value during that year, this is something that most people are not, it never got headlines. The total asset value of the bank failures in that year was greater than in 2008
Interesting.
by dollar value of the businesses.
You don't have to put your face down into it, but just put it in front of you. That's all.
Okay. Yeah, so the total dollar value of the bank failures, I don't think it was 2002. I think it might have been 2000. Whenever the Silicon Valley Bank hit. And then there was some big ones in New York. But the total value of the bank failures in that year was greater than in 2008.
Well,
but it got no press.
So, but inflation adjusted, I don't think it was probably the same.
No, inflation adjusted, certainly not.
Yeah.
No, I don't think it was the same either.
I mean, at the end of the day, let's go back to 2008. WAMU was considered the second largest bank by retail banking assets, or whatever, right? And they were still not too big to fail.
Yeah, I just don't think that they were had enough history, and they didn't have a seat at that table on the right.
Actually, that's not it. That's not it.
On the right
That's not
weekend.
They
it.
didn't have somebody that could go like, hey, what about us?
Yeah.
No.
They weren't in New
They
York.
didn't have it.
No.
They were not.
So actually, no. So I mean, I don't know if you guys know about this.
What happened? They were in Seattle. They were Tacoma.
No, that's not the reason why. That's not the reason why. Because at that point, they had enough presence that they should care. The problem with WAMU is that they were a thrift savings and loan bank, and there's a percentage of their business that has to come from residential banking. And so as a mortgage banker, I could tell you this history because a lot of people don't know this stuff. This is actually the version of The Big Short that they never talked about. Like this is actually a chapter in The Big Short that was never talked about, or in Margin Call. So the when they're securitizing all those assets and there's buyers for those assets, WAMU, although they're kind of portraying themselves as this like a paper bank, was the largest purchaser of subprime loans out of everyone, and it wasn't even close. So if you actually go through the top rankings of the top subprime lenders, like Ameriquest, New Century Mortgage, all them. When I worked, I worked at Ameriquest back then. It was my first mortgage job. I didn't know what I was doing. It's like here's a list and here's a product. Go do a mortgage, right? 23 years ago, when I got promoted to a manager and we went to corporate, I found out that close to 60% of all the paper sold directly to WAMU, never on the open market. Sold directly to them from the number one subprime lender. And when I talked to colleagues that worked at New Century, Option One, all that same story, because the story on them was the reason they got so big so fast was because since they were through a savings and loan, they had to have a certain percentage of their business that was in home loans. And so that required for them to keep buying these assets so they could keep growing.
Right.
That's what really happened. And so, and it was the word on the street is that if you were brokering a subprime loan, and they had another arm that was affiliated but not purely owned by WAMU called Long Beach Mortgage. And the word on the street is if you ever had a big subprime loan that you had a hard place placing it, is if it was a bigger loan amount, Long Beach will find a way to get it done. And the reason why they felt that way is because they cared about volume, because volume allowed them to grow more branches.
Right.
So the real story was they were so toxic they couldn't be touched. That's the reason why they were too big. They weren't too big to fail.
Right. And if they were evaluating the tranche debt, then they knew that the subprime loans were the most.
They were toast.
Well, so the whole reason that came up was we were talking about the optics of this most recent sell-off.
Yeah.
And I think one of the most healthy things in equity markets, and one of the things that I enjoy the most about it, is price discovery. Because if someone liked a position 90 days ago and they don't like it anymore, well, they didn't like it enough 90 days ago.
Right.
And some of these companies that were being bought with significant volume 90 days ago are down materially, and not because of the fundamentals, not because they've had bad earnings, not because, right, like the fundamentals are still the same that they were 90 days ago for many of these companies that have sold off pretty substantially. And then you would say, okay, well, if there's no fundamental changes, then has the forecast or the outlook over the next 3 to 5 years changed materially? And for many of them, the answer is no. Right? Now you also have to, so when you're looking at it from this 30,000 foot view, you could say 90 days ago, the technology sector was starting to get a little bit overvalued. So year to date, we've seen a 10% correction in the technology sector. Well, have we seen a 10% correction in the Dow? Right? No, it's flat. I mean, I think as of this morning, it's flat on the year. So we haven't seen a correction in the Dow.
Right.
And we haven't, the S&P is down, but it's not down 10%, like the NASDAQ. So there has legitimately been a rotation in sectors.
Yeah, but some of these
and
companies in the
asset
tech
classes
sector are so cheap right now.
relative to the historical pricing, but cheap. If you have to define cheap. If cheap is measured by PE, and a company is, if the historical PE of the S&P 500 is 20 or 21, so it typically ranges between 18 and 22.
That's correct.
18 is really cheap. 22 is starting to get
tech
more
typically
pricey.
trades closer to around a 30, right?
Well, it has been for the last 10 years, right? Of high-end, really valuable companies. But if you get a company like NVIDIA that's now trading at a PE in the 30s, in the high 30s, or Apple.
Well, let me just let it out. The company that I've been tracking is Google. They're trading at 19.
Yeah, historically cheap, especially given all of the advancements.
On top of the fact that even albeit it's a small dividend, but they're still paying out dividends. So you can get Google today at a PE ratio at 19, and they're still paying out some dividends. I'm like, this seems ridiculous to me. I just don't understand it. And
well, you're not alone, right? So a lot of analysts feel the same way, but there are reasons why because it's like, okay, well, what is the likelihood that the company is going to double up? And they've allocated a pretty heavy commitment to R&D, and they've allocated to this whole AI boom. And so it's, how is that going to materialize? How is that going to, once it takes shape, then I think ultimately,
I guess what I'm
it
trying,
will be reflected in the share price.
Maybe not quite to where Meta was at, but it's starting to feel a little like, to me, if it sub 20 on forward earnings for Google, it's like, guys, are they still not the number one search engine with search engine media. I mean, has that gone away? No.
No.
Do they? Let me get this correct. Do they still own YouTube?
Search. Yeah.
And still have all the search media or all the video advertising on YouTube, which is more revenue than all the old network televisions from 20 years ago combined. Is that still a thing for them?
Yeah.
Yes. Okay. Then why are they trading at a forward earnings of 19 with and still paying out dividends? It just seems crazy to me.
Yeah, it happens. Well, I mean, it happened to Apple in 2018.
Right.
Apple's share price plummeted. I mean, there was
I sold my Apple
rationale. There was rationale for it at the time, but it took 6-8 months to really recover to its.
This is definitely not advice, but I sold my Apple position. I think I told you I sold my Apple position.
I did too.
Yeah.
I told you that.
Yeah, you did. You gave me the idea. Yeah, you gave me the idea. Yeah. But I, in all fairness, I was bitching about their stupid. God, I'm so done with Siri. She's such a fucking
That's
idiot.
what we're talking about.
Yeah.
Remember?
Yes.
Even their autocorrect on the text messages is
Stupid.
ridiculously bad.
I'm like, guys, what are all these new features you're trying to shove in my face? Fix, do you remember T9 predictive text? I'm going to age myself a little bit here. Do you remember that technology? Okay, before smartphones existed and texting was growing, T9 predictive text was this thing where you just use the numbers on the numbers have that. There's letters on the keypad.
Yeah.
T9 predictive text was basically saying text on your number pad, and don't even tell us which letter you're trying to do.
They'll put them together.
You don't have to hit the 6 3 times to get to the third letter. Just pretend that's the letter you meant to press, and we will actually predict what you're trying to write. And it was right way more often than fucking Siri is with a full blown keyboard.
Yeah.
It was way better. And this is, how old is the technology now? 25 years, I think, maybe close to 25 years, maybe 23 years.
25 years ago? No.
2000.
Yeah.
Well, then that's 25 years.
Yeah, close to 25 years, over 20 years old, right? And the T9 predictive text did a better job of trying to predict what I was typing with a 10-digit number pad than a full-blown keyboard from Apple.
Yeah.
And I don't understand how they can't fix that.
They can. They're not going to be wrong forever.
I don't know. They've been wrong for a pretty long time.
I don't know. I'm starting to feel like they're Kodak. I'm like, guys, if you don't jump into the space that matters the most. I mean, here's my gripe with Apple. Okay, they are a tech company, but in the space that they're in, and the way their product is designed, and the way they own their platform, I would say that they are the smartphone version of, let's say, Rolex, where we already like your product. You don't need to reinvent the wheel. Just refine it and make it better.
Yeah.
Just refine it and make it better. You do not need to be groundbreaking. You don't even need to be first. You just need to keep making it better.
Yeah.
And the core fundamentals of what you do is the first things you should be making better, right? Mm-hmm. Imagine if Rolex would dominate a market, but their biggest issue was they just need to be serviced more often because they had these outdated movements. Well, then update your movements, right?
It's not exactly the same though, because they're in the tech space. There's going to be something that is going to take them over.
Interestingly, though,
these
it's a
phones
consumer
are
product.
not going to exist very much longer. Have you used the? Have you guys ever tried the Ray-Ban glasses? I think they're
not yet.
No,
they're ridiculous.
I'm looking forward to it.
They're
though.
pretty sick, and that type of stuff is only going to get better. They should be getting better with this as well. But when we talked about this when we were talking about it, and it wasn't my idea. I just heard it on a podcast or something. But they are sort of morphing into how you would describe Rolex though, which is just a traditional, established business. They're not trying to grow 25% a year. They're trying to grow 8% a year. You know, and when you have those different metrics, then your share price is going to be different as well, because your expectations are it's like Coke.
Yeah.
Right?
Well, I think that they're a long way from being Coke, but
they haven't released a new product that was successful in at least 10 years. Their newest thing is that you can make emojis with your face. That's what their advertisements are about.
Well, and how long? I mean, how long's the watch been out? I think the watch was a pretty big success.
The watch was a success. and then
I'm just saying, though, you don't buy a Rolex though for it to tell the time. Like you guys don't own the Rolex because it tells time.
Yeah, but you
No,
can't.
it falls purely.
But you
purely
can't.
with
You
that
can't.
one good.
You can't let other manufacturers who make watches outperform you in keeping time.
It wouldn't
what I
actually.
mean?
I don't think it would matter if the Rolex told better time or worse time.
Not-
right now. I don't think.
Yeah,
anybody
not
would
any,
care.
not well. I think a certain population would care.
Not most of them that want to just flash a Rolex.
Yes, but if they
Yeah, but that's not all, that's not everyone.
but it
It's
can't
not everyone.
it
It's the
can't be
same as
massive. It can't be
95% of
massively
the market.
flawed.
Sure.
It can't be massively flawed at keeping a time. That's
What does massively flawed mean? Like it's an hour off?
why I think that not being able to text properly on your iPhone is a massive
I
flaw.
agree.
But like I'd say that for the purpose of like mechanical watches, if it doesn't have a reliable automatic movement, then it would be a problem. Because people literally just translate that to Rolex. It's the whole perpetual, right?
I understand, but what you guys were talking about, the newest watch, it didn't have anything to do with its performance.
Actually, it does.
It. How so?
Oh, I ain't gonna get too watch geeky on
Tell
you.
me
but-
what you guys were talking about had nothing to do with performance. It had to do with the story. It had to do with Tiffany stamp or something.
No,
right?
well earlier. No, they released a new watch yesterday, and they call it the Land Dweller, and it's their first massive upgrade to their automatic movement. You know, there's been some improvements to like the escapement technology in watches, and they're later in the game of doing it, and they're okay not being the first to come out with it. They just need to be the most reliable, best version of it, and so they've let companies like Omega for a handful of years say, oh, look, we have better technology than yours, right? But I would translate that somewhat to like how BMW might be the first one to bring out a technology, but there doesn't necessarily mean they're going to execute it better than Porsche will.
No, but nobody cares. Nobody cares because they're not buying a Rolex for performance.
They don't want to buy it for it to break, though. And that stuff does make a difference in terms of like wear and tear.
And I think that there are just like in the motorsports community, there are large swaths of people that buy a particular vehicle because of its technical abilities and performance.
Yeah, but we're not talking about.
And then there are people that buy.
We're not talking
buy
about
those same vehicles
no,
for status.
We're not talking about motorsports enthusiasts. We're talking about people that buy sports cars. The motorsports enthusiast is a decimal of a percentage.
Yeah, but
Okay?
there's a
The
translation.
same with
There's
yes,
a
it
translation
is.
between
Look
hype
at all the
and
Porsches out there on the road. How many people do you think own a Porsche because of its performance, or because it's a Porsche and it looks cool on the road?
Okay, but let me counter that.
Yeah,
The
I
community-
think that there are
the-
two different types of buyers.
Right,
One
but
is
what-
aesthetics
Yes.
and
aesthetics
image.
is- the aesthetics-
Aesthetics and image, and then function.
But here's
Aesthetics is a big
here's what
piece of the
happens though.
pie.
But here's what
The
here-
function is a tiny piece of the pie.
it
That's what I'm
is
saying.
kind of.
saying.
That's a slant.
Let me
it
argue.
depends on the
Let me
community
argue that
you're
here.
in.
No, it
Andrew-
doesn't, because we're talking about the world.
Okay, Chris, so here's the thing. Even in a world of broad stroke hype, I'm buying it because it's cool, whatever, right? The people who buy it on the hype and because it's cool, that only can last so long when the other community doesn't back it. I think a perfect example of that would be like Hublot. They've done a good job of making watches that based off of a design element look nice. And after enough like watch nerds have said, you guys are so fucking stupid for spending that kind of money just because it looks cool, because it mechanically is a total piece of shit. Eventually it starts to bleed out and it's like there's the Hublot people. And that happens in all communities, and that would happen in the car community too. And so a perfect example of that is they tried to do that to Richard Mille. They tried to say, hey guys, you guys are fucking crazy spending $200,000-$300,000 for this gigantic, what they called ugly at the time, watch. But what held its esteem is people said, but wait a minute, what do the watchers have to say? At first, they all tried to like slam it too, like, oh, who's this guy trying to make these watches? They're gonna be like Hublot's. And then they start to really look under the hood and they go, oh fuck, these guys are really doing some cool shit. And then the people on the downline don't even understand what that stuff is, but they know that the people they're listening to should be respected. And then now the establishment and esteem of that product keeps rising. And now they think, I want to say RM is like in the top 10 for annual sales.
Yeah,
even though
there's a reason. There's a reason for that. It was on every wrist in every tennis tournament. It was on every wrist in every golf tournament. It was on every wrist in every F1 weekend.
This is my point, because I don't even know, I can't even actually repeat the name of the brand. I've never heard of them. Okay, because
It's a cool watch.
They're fucking.
that's what I'm saying though.
I mean,
that
what,
is my whole point.
I mean, what would be?
It's not everybody's flavor because they're
no,
usually
but
very
what's
bright,
what's the
very
car
bright.
equivalent of an RM right now? I don't even know. Maybe Bugatti. I don't know.
No,
No, probably not.
I would say. I mean, really, I would say it's probably something in the Ferrari echelon. I would say they go together.
But they're newer though. They're newer, so I don't know if there really is a car equivalent. Someone who's made a splash recently, who everyone's turned to is like, oh shit, look what those guys are doing. They're really doing some
yeah,
stuff.
you mean like in the last 20 years? Yeah,
Yeah.
a car company that's come out that's done some cool stuff in the last 20
Yeah.
years. That would be an equivalent.
Yeah.
But I would put Richard Mille
and
Ferrari in the same camp.
I would
The
say
car
I would say
equivalent.
what RM has done in the watch community in the last 10 years is like what McLaren did when they came out with the F1 20-something years ago.
Yeah.
Like where like everyone had already been established, and here came this car where everyone's like, oh fuck, what was that? Right?
Yeah.
And who did it? Right? Yeah. And they kind of just made this big splash. And I think that where that brand represents in the watch community now is probably a little more elevated than McLaren is now. And McLaren's got a great establishment now, but like what RM is doing and the kind of prices they ask for their product, it's nuts. I think the comparison to Bugatti is probably more to do with the price point.
Yeah.
All right.
Okay, so hold on. I want to come back off
I'm
this
gonna-
tangent.
Here, I want to too, though, because I have a higher level question that I'm curious about, with not regard to the car and the watch stuff, but the market. So, the market is obviously sort of in a interesting spot.
Yeah.
Do you think it's okay? This is gonna be like I sort of I guess a political, maybe just a world economic question. I don't know. What I'm curious about you guys' opinion is, do you think that the market reaction is a result of like the news cycle and the way that things are being reported that the new administration is doing, because they've come in and done a whole bunch of new stuff?
Yeah.
Do you think it's because of the things that they've actually been doing?
I think yes, primarily because of tariffs, right?
But I don't think the tariffs have really even started yet. They've just been
They
discussed.
just started,
yeah, I mean, tomorrow I think is when the car thing starts.
That's how the market is. It's always
So-
like it's always forward.
But my my question is it actually going to make a difference in the market, or is everyone just reacting to this news?
I think some of it's real.
So you get a shift. So you get the thesis of like a shift in accounting methodology. This is a shift in very, very much the same side shift. If you have a shift in accounting methodology, and you're bringing, historically you counted 90 days accounts receivable on your books as an asset, right? And then you say, okay, well, I'm no longer going to take my 90-day account receivable and count it as on my book value. I'm going to have like a just-in-time accounting methodology, which only accounts for revenues I've received and shipments I've made, right? So like if you change your accounting methodology, then all of a sudden you can have a change in the value of your company, because you're no longer reporting future earnings as a book value on your book. Okay, so basically that's what's happening. We're having a change in how what the revenue makeup is going to be in the country. So there are four primary factors that make up GDP, right? GDP. So recession has historically been defined as 2 consecutive quarters of negative GDP.
Right.
And historically, it wasn't really like a rise in unemployment. It's just two consecutive quarters of negative GDP. And if we see that this year, well, it's going to be because of these four factors. And what are those four factors? Well, the biggest one is consumer confidence and consumer spending. It makes up a majority of the U.S. economy. We have a consumer economy, and if the consumer gets a little hesitant and a little weak, then all of a sudden then there's cracks starting to show. Okay,
If we stop giving everybody free money,
sure. So there's this big element. Okay, and there are some some warnings that are starting to show up in consumer confidence. Like for example, I think for the highest we've seen in the last 15 years, maybe 20, but 15 anyway. 30-day lates on mortgages are now higher than they've been any time in the last 15 years. So that catches your attention when it comes to consumer confidence. And
by the way, real quick.
Yeah.
I've been seeing this graphic go around on Facebook about like this 6.1 million mortgages are in arrears. And then I see everybody saying this is not the correct data. It's like based on multifamily housing or some kind of craziness.
Yeah, I've seen both of those
Yeah.
things. Yeah.
Anyway,
Yeah. So it's better to just go to the source.
Yeah.
You know? So one is consumer confidence. Two is corporate investment. So interestingly, all of these policies that are coming out of this current administration are incentivizing massive corporate investment in the U.S., even with relatively high rates by the last 20 year standards. Even
That's
the rates
kind
are-
of the point.
So Apple. So
Right.
I'm pretty convinced. So in Trump's first term, Apple did not pay a tariff. Apple got a waiver, and they didn't pay the tariff on the imports of their goods. So that wasn't reflected in the price of their goods. So even though, and there were some considerations as part of that in the first term.
right.
This time, Apple has made a commitment to invest $500 billion in domestic manufacturing in the United States. Taiwan Semiconductor has committed $100 billion in manufacturing in the United States. Honda has committed to building the largest manufacturing plant outside of Japan in Illinois, and that's going to be tens of billions of dollars in manufacturing. There's a long list of companies that are committed to investing hundreds of billions of dollars in domestic manufacturing. That corporate investment is a cornerstone of GDP in the United States. So there are two factors. If we can keep consumption relatively strong and the consumer remains and the average household remains relatively strong, and corporate investment gets a boost, and we see a heavy corporate investment, then we're going to see positive GDP numbers from those two sectors. The third one that's been propping things up is government spending. And government spending is getting cut.
Correct.
Yeah.
I mean, it's happening at a slower rate than everyone kind of initially thought. But the fact remains, if we're $2 trillion in deficit, spending $2 trillion more a year than we're collecting in revenue, that becomes a problem, because then eventually the interest on the
Right.
debt service is more than
Right.
any other line item in our
getting
international,
close.
and it's getting close.
Right.
So
It's the magic of compound interest.
but
in reverse.
working against you. Right. So there is a forecast that says if we continue on this pace,
Right.
in the next 5 to 7 years, the
US will
interest
default on this. Yeah.
No, we won't default, but the interest on the debt will be more than
Right.
we're spending on military defense. The interest payment on the debt will be more than the single largest line item
It's
in our
like
budget.
40 cents of every dollar will go to interest or something.
Correct.
Crazy.
Yeah, something insane. So we have to eliminate
Yeah.
we have to eliminate the interest on the debt, and we have to eliminate deficit spending, especially $2 trillion a year in deficit spending.
Right.
So if that comes $500 billion this year, $500 billion, right, over the next 4 years, it is possible in this administration to balance the budget, which would be the ideal pathway to balancing the budget and no longer having
just say that
deficit
out loud?
spending. Yeah. Well, it would be the first administration since '98, since Clinton did it in '98, which
some
I
of that-
was a senior in high school that year.
Some of that would be offset with these tariffs as well.
Okay. So but that's a revenue source. So we're
Right.
going to get to that.
Correct.
That's separate.
Yeah.
So the fourth pillar of GDP is net exports. So for the last 25 years, if you look at the negative net trade deficit that we've accumulated.
We talking about export. It's like
We're talking
what are
about-
we sending out to the world.
Okay, so how much we buy versus
From other
how much
countries.
we export.
Right. What we buy though, import.
Yes.
What we give, export.
Yes. Now, the average over the last 25 years has been a negative, meaning we're importing 650 billion plus or minus on average over the last since 2000. It's been 600 plus billion. But lately, it's been almost $1 trillion a year that we are bringing in versus what we're exporting. And so when we try to sell our goods in China, we don't get the same
Which is why all these other
treatment that
countries
they get when they sell their goods here. And when we try to sell our poultry and dairy to Canada, we don't get the same treatment. As a matter of fact, many of our industries aren't even allowed to operate in Canada, right? It's not an open playing field in Canada for U.S. companies to compete in that market. As a matter of fact, I would encourage anyone that listens to this, just take a minute and look up the tariffs on what poultry and dairy are when we are exporting goods into Canada versus what they were paying when, right?
Right.
So I get this idea of reciprocal tariffs and why it makes sense because there is a very just and valid argument.
Which also explains why a lot of these countries are getting so pissed, because we've allowed it to go for so long that they become dependent on it, very much like we become dependent on
100%,
imports,
right? So it's and I understand why it's ruffling a lot of feathers. Because it's upending this, gravy train that has been the United States on the losing end of enriching other nations. And so, but at what cost? At the cost of not investing in our infrastructure, right?
Well, it's right. We've been doing it to avoid a short-term pain that very few people, I would say, in political leadership positions want to endure.
Yes.
Right? Because it's
Yes.
No matter where you politically lean, there are going to be times when leaders need to make choices that are not going to feel especially good.
That's right.
For you in the short term.
That's right. Well, okay. So
And we've been avoiding those
then
for a long time.
and then there's this whole other deficit reduction strategy. And one of the big ones is there's this thesis that says, okay, if there's a million people a year for the next 4 years that want to participate in this golden visa program. Well, if it's $5 million bucks. So there's more than enough billionaires outside of the United States around the world that if they want a golden visa residency in the United States, and they want favorable tax treatment to be in the United States, if a million people pay $5 million, that's $5 trillion, and if a million people a year do it, that's $20 trillion that goes directly to the deficit reduction. So there is a rhyme to the reason if you can just look at it objectively and look at the data and not be blinded by the whole politics of it all.
Right.
It really boils down to just a shift in thinking.
Yeah, there's some other second and third level consequences too, because if you provide more private sector jobs, well, you have less government bloat to sort of make up for the difference.
Mm-hmm. Sure.
Because it's not just government, it's not just like sending money out to people. There are so many jobs and things that exist only to prop up sort of the American economy, right?
Yeah.
Like if you look at the percentage of people that work in the government in the United States, it's way bigger than you would think it should be. It's like, I think it's, I'm just making up numbers, but let's say it's like 12%.
Yeah.
It's 12 out of every 100 people are working for the government. That seems like a lot,
Yeah.
right?
It's a lot.
It may be more than that. I just made that number up, but I know it's a lot where you hear it and you're like, do we need that many people like pushing paper, whatever the government does? Especially you got to, I worked in the government, Kansas state government. I mean, we had people that were there. They just show up and they would do nothing. They would read the newspaper all day, but they've been there for like 25 years and it's really hard to fire them. Like you basically can't fire them.
That's a whole separate.
I know.
So you're talking about the kind of the lethargy that sets.
I'm just saying though, these different things you have less.
Yeah.
That has been, again, I think one of the ways to avoid this short-term pain is to put these Band-Aids on things, which is let's just create some more jobs inside of the government to make up for some of these things that we're missing because of.
Well, so yeah, I wholeheartedly agree with you. And to tie this into part of the conversation that we were having earlier about the 2008 and the kind of the financial collapse that occurred in that time, there was the big term that came out of that, which is this moral hazard, which was the disconnect of people that were making decisions that had with money, and they didn't know the end user, right? So there was this massive disconnect about what they were doing and the risks they were taking with money that was A, not theirs, and B, there was no connection to the person that was going to be financially impacted by that. So in general, there was this whole phrase that came out of the 2008 financial crisis that was called moral hazard. Well, the same thing applies here. If you have people that are in government that feel no sense of obligation to maximizing the return on the taxpayer resources, then you have that same disconnect, which is that, you know, I'm in public service, I'm working for the government, this is taxpayer money, but I have no connection or sense of service or obligation to my community. Then you end up finding situations like that where people are not worried about maximizing their productivity, and that's where, you know, that's where things get murky and they get really challenging because there's no consideration and things start to break down. And the longer that goes on, the bigger the problem gets because nobody's willing to face the music. Now we happen to have a current administration that is largely unpopular with a whole segment of the population, and they don't really care if people hate him.
That's right.
He just doesn't care if people hate him at all. He's just accepted it as kind of part of life. Okay,
I remember having a conversation with a friend of mine a long time ago about what it meant, just in general, about second-term presidents, about the kind of policies and the positions they take are typically just a lot more aggressive because the goal of getting reelected gets removed.
They can, but that cycle never ends because even as a second-term president, you typically are still at the beck and call of the people in Congress who have midterm elections, have their other long-term cycles.
Yeah.
And everybody's putting pressure on you always to kick the can down the road as far as possible. And in this particular circumstance, they're basically saying, we don't care.
Well, and it's important because I mean, we're how many months into this now? We're just a few months in.
I think it's like 70
And
days.
Interestingly, you know, we're seeing all because of where we live, we're seeing like the vitriol and everything. You saw the stuff going on in the Tesla, you know, dealership downtown and all that stuff.
Yeah.
Downtown
That's on
Bellevue.
one side. Okay, so that's on one side. But on the other side, if you just again zoom out and you look at the national poll numbers, this administration is polling more favorably than at ever before in the last 15, you know, at any time, even since before 2016. So this administration has more. It's not just that there was a popular vote win, and right. It's not just that how the election results. It's now we're a few months in, and if you're actually looking at the real time results of what people are saying in all of the polling results, yes, there's this large segment of the people that are really frustrated and hate his guts. Right? They hate this administration, but more people than ever are happy with what's happening.
Well, it was the same people that voted against the administration for the most part. Because what's happened is, whether you are for it or against it, what they've done is just exactly what they said they were going to do.
Right, which really hasn't happened in a long time.
Ever.
Yeah.
Really ever. Because it's been hard. It's been hard.
It is very hard. And you know, and to give Obama credit for what he really inherited, which was the financial crisis. I mean, when you kind of walk into something like that, then all of a sudden, you know, whatever agenda you had has to get put on the shelf, and you have to address this major issue. Whether I agree with how it was addressed or not, I can at least objectively acknowledge that a shift in policy was required because he couldn't prioritize in his first term. He could not prioritize universal health care, for example.
If your house is burning down, you got to put the fire out.
You can put the fire out before you worry about medical care.
You can't go feed the chickens before you put the fire out.
So the financial crisis really put universal health care on hold in the Obama administration. And I think every new presidential administration has to deal with this. But this time, in this administration, I mean, after Trump lost the last election, Biden became president, I mean, he was sent to the wood chipper. I mean, you know, that is political death zone. Like, there's never before was someone so unfavorable to come back and then win a presidential election. I mean, his favorability was 20, like down in the low 20s when Biden became president.
Yeah.
So,
but I mean, you want to talk about
let's close the loop on this.
Yeah.
Is it some of the actual policies? Is it news cycle? What is causing this market correction, slide? however you want to define it. What are your thoughts on that?
So I think it's lack of optics and framing. If we just go to 2002, this administration had nothing to do with that.
Yeah.
The S&P was down 20%, the Nasdaq was down 30%. The following couple years were really good in the equity markets. This year the Nasdaq is down 10%. The Dow is basically flat. The S&P is down, I think, 3.5-4% as of this morning. So we're talking about price discovery on individual assets, because there are a lot of really big companies out there that are not down. Right. There's a long list of companies that are not down. The companies that are seeing the most pressure are either socially, there's social pressure on some of these companies. But again, we talked about this a little bit earlier, where the fundamentals haven't really changed. There's this forward-looking forecast of what is this pressure that's being applied going to lead to.
In some ways, though, is it probably just people pumping the brakes a little bit because there's so much change happening? It's
I think that's part of it.
Well, there's an idea of what the outcomes might be, but you don't really want to overextend yourself either way.
Yeah.
Sector rotation is real, though.
Selling positions and putting money to the side and they get your popcorn and watch is definitely, I think, a part of it.
Well, and sector rotation is real. So anybody that bought NVIDIA 5 to 7 years ago and rode this insane rally, for those people taking 20 or 30% of their position off the table and allocating it to staples like, Coca-Cola, right. McDonald's, right? For companies that Visa, MasterCard, like these are companies that are not down year to date. They're off their highs, but they're not down.
Right.
And so, it's not unreasonable. And money managers are going to guide their clients. And sector rotation, if you have peak valuations, which was what we were having at the beginning of this year, we were seeing really high valuations for a lot of these companies, is totally sensible. So seeing a rebalancing, seeing sector rotation, where you really start to get concerned is if you start to see cracks in the fundamentals, right? If you start to see declining earnings or earnings misses or large swaths of leadership change, right? Then all of a sudden, you start to raise an eyebrow. But when the fundamentals are still there, then you say, okay, well, what is this really? And it feels like price discovery and sector rotation. That's because if you look at what's happening right now versus what was happening in 22, I mean, it's like it's not even close to the same.
Yeah.
Yeah.
So that's my general view, is that I don't think, and by the way, I'm not alone. So a lot of analysts feel this way, and I think price discovery is very real. And there are sectors of the market, like sometimes in the bond market, where you don't really get a lot of price discovery, right? Because the Fed was buying huge amounts of debt, which was a relatively new thing a couple of years ago.
Yeah.
So I think that my favorite thing about the equity markets is this price discovery, where if a company sells off too much and then everybody starts looking at it going, I really like this company 90 days ago. Fundamentally, nothing has changed,
right.
Now it's great,
basically.
Right? I mean, what you just said technically. So when I talk to people about investing, what I tell them is this: the only way you can tell if you're investing versus gambling is if you really feel like you know the value of it, what you're buying. And so the example I would give is, I mean, this is probably not the best example because tariffs might jack up their prices, but like a lot of people understand what they pay for a brand new iPhone, right?
Yeah.
And they've renewed their models maybe every 3 to 5 new model releases for the last 10, 15 years. And whenever they do it, they have this idea of what they're going to spend, inflation adjusted. And so that means if tomorrow someone said, a store came out and said, we're going to sell brand new iPhone 16 Pro Maxes without a contract for $400. The standard public says, well, that's a really good deal. How many will you sell me?
Yeah.
And they'll buy a bunch, right? And then if the same store a week later said, hey, guess what? We're going to sell them for $250, limit 2 per customer. If your reaction to that is, oh, go buy the 2 on top of it, on top of buying as many as we could at $400 the week before, right? Mm-hmm. That's because you understand what the market value of the asset was. And that when it went on sale, you were excited and went sale more, even more. But what happens is if you don't really know what the asset's worth, and if you don't really have confidence that it's undervalued, then what happens is that when it does go down, you can't tell if it's going to continue that trend to zero.
Yeah.
And that's when you get afraid, and that's when sell-offs happen, and that's when you know you were gambling because you didn't really know how to evaluate the asset from the beginning. And so my reaction to that is that if you ever, if the feeling that you need to sell because it's down ever enters your mind, then you should have never bought it to begin with. And if you don't understand that, then that's why people should just invest in the S&P. If you understand what that is, because it's always just the 500 biggest, best companies, right?
Yep.
And if someone falls out that 500, then they get replaced with someone that's better. So then, you're just betting on the U.S. economy that the best 500 companies are going to do okay, because it can never go to zero then. Because if any of those companies start to go to zero, they'll get replaced by someone else. That's just how the nature of how the index works. And so, but people, in this price discovery that you're talking about, are finding things where they just can't. If you have to ask yourself 5 different times, why is it so cheap? You probably could have stopped at the 3rd or 4th time and just bought the stupid thing. Right?
Right.
Which ultimately is kind of my opinion of Google at the moment. I look at Google and I just don't really, I don't understand it, right? But that's my opinion, and I bought some.
Well, so interestingly, I very much have the same opinion. You know this. We've had this conversation many times over the years. But when Biden took office, I was looking at the PE the PE ratio for a basket of energy stocks. There's an ETF that represents a basket of oil companies. And at the time, the PE ratio was 5. And
energy companies do trade lower.
The PE ratio was 5, but the dividend of this particular ETF was almost 8%. Meaning that the market thought, this is the way that translates, because this ETF was a basket of all of the largest oil companies, right? Not one, but all of the biggest oil companies. This one particular ETF. And the PE ratio, the blended PE ratio of this ETF was 5, and the dividend was 8%. So what that meant was that the market believed that the average of these are because they call it 25 largest oil companies on the planet we're going to be totally gone in 5 years. I mean, you look at that objectively and say,
not probably going to happen.
Right. Maybe not. Right. Yeah. And then you come up to, the financial analysis that you go through when you're looking at a position. You're like, wow, that's kind of seems cheap. Right. Yeah. So you have to ask yourself, do you believe that Google will be obsolete in 19 years? Because its PE is price divided by earnings.
Right.
So the current stock price is represented by 19 years of their existing earnings. So do you think that their earnings are not going to grow, or that the company is not going to be viable anytime between now and the next 2 decades?
Even those factors are broken down. I mean, ultimately, when you evaluate a stock, I think that there's that factor, that main factor, that kind of gets broken down to a handful of sub-factors. Their position to market share, do they have a good defensible moat in terms of their position, the quality of their leadership, right? And so you can kind of break it up to about 4 or 5 different things, right? And I think their CEO has done a good job, and I feel like they have a good defensive moat on their positions where they are clearly industry leaders.
Yeah, and relative to their peer group, they're competitive. I mean, the valuation relative to peer group is
in a new sector that is obviously the most growing sector in AI, they are doing pretty well. They're actually considered one of the leaders in that space.
And Willow might be one of the most innovative chips made, I think, ever. Right. I mean, quantum computing we're getting closer and closer, and they're on the forefront of that.
Right.
Now, how that translates to revenue is a whole nother thing. But the
revenue the revenue that the company does rely on, to translate to that 19 times forward earnings, is a position that no one's even threatening to try to take. I know Microsoft keeps forcing my hyperlinks on Outlook to go to explore, right? But I just copy and paste that shit back into Chrome. You know what I mean? I'm not staying in that platform, guys. I'm just not doing it. I appreciate the effort. I know you guys are a local company, but like it's moving back over to Chrome. And so I don't see anyone even getting close to trying to compete with them in the space of like advertising for like, for in the video space, like the way that YouTube does. It's not even close either.
Yeah.
So, but those are just my opinions of it, right? It's funny because you're right. The whole sectors are down, and I've kind of gone through a handful of companies. I included, even, I thought, hey, maybe it's a good time to buy Tesla. I mean, people are blowing up Teslas because of Elon's relationship. There's got to be a point where it gets discounted enough, but I just can't underwrite the company well enough. I understand people tell me the fundamentals, and they're still trading at like close to 40 forward earnings, and it just
but so one of the things I always like to do just as a fun experiment when companies are getting beat up on price, I always like to say, okay, well, what is the market sentiment? Is this like a forever market sentiment? And and the way that you measure that is like in the options world, there are people, the options prices are set. So there's a market for what the market believes. There's a whole, what they call an options montage,
right,
that sets a price on an options contract for what they think the stock is going to be worth in 3 months, 6 months, 9 months, a year, 24 months. And it's funny, and it's just a point of exercise. If you want to know what the market thinks the stock is going to be worth in a year or 2 years, especially after it's been beat up, just look at how they're pricing leaps, options that mature in a year, 18 months, 2 years. And in many companies that are really beat up on price, if you look at the options contracts a year or two out, they're still very expensive, which means the market thinks the stock price is coming back.
right.
Because if an options contract, out of the money options contract is expensive, if an options contract is 20 or 30% out of the money and it's still very expensive, then that means that there's a buy and sell, there's a market mechanism here that's setting the price of that option, and the market believes that the stock is going to recover even if it's been beat up on price. So some of these companies that have been really beat up on price, if you look at the options, which is a market, which is an open market that tells you what investor sentiment is about the stock in a year or two out, they're still very expensive. It's not like, okay, the stock is down and the options are cheap,
Right.
which would mean that everybody thinks that the stock is down and it's going to stay down.
Right.
So
Which is Kodak.
right.
Right.
That's like okay, there's going to be a fundamental shift in the how these business operates.
You're a sinking ship.
Yeah.
Yeah.
So anytime I look at a stock price that's been beaten up on the short term, 90 days, 6 months, right? And you say, wow, they're trading at their 52-week low.
Which I want to give a precursor. The reason why I reference Kodak for anyone who might be listening to this show, the 5 people who are, it's because their unwillingness to adopt and embrace digital photo technology was like their big downfall. Like they're well known for it, that they were industry leaders. Everyone knew they're industry leaders in the photography space. And here comes digital photography, and they just wanted to stick to analog. They're like, it's not going to change. It's not going to be groundbreaking. We're still going to be going to those little development rooms, the red lights, and developing. We're going to still buy those portable cameras with remember those things, right? And they were wrong.
Well, they're not the only ones.
Right.
Blockbuster had the same thing with Netflix, and they're not the only ones.
Yeah.
But I do believe that there are. So my own checks and balance when I'm looking at a stock that has been really beat up in the short term, and the underlying fund, maybe some of the future forecast because of the social unrest and all of that has changed, but the fundamentals really haven't changed. When I look at a company that's been really beat up on price, kind of my cheat sheet note is I check the options montage for 9 months, a year, 18 months, 24 months. I just look at what do investors think are going to happen in the share price. And if the options are still really expensive for a year or two out,
It's a good sign.
it's a really good sign that the stock is trading substantially lower than it should be because the market is pricing it.
It's at least some
That's probably the
confirmation of what you are thinking.
Yeah,
It shows you other
it's
people
a
are
data
thinking-
point that
right.
I use to confirm. It's like,
And I would say it probably
is
should
this
be-
really cheap or is it not?
I would, and maybe I'm not correct to this, but I would take that as a data point of like the last one. So you want to say, do I like the product? Do I like the company? Do I like the leadership? Do they have a good defensive moat of the industries and product that they hold well in? And do I feel like they're going to be around? And do I use that product well, and all those things. And it seems like it's way too cheap when you look at some fundamentals like forward earnings and so forth. When all those check out and they all say, yes, it's a good buy. Yes, it's cheap. Yes, you like the product. Yes, you like the leadership. Yes, you like all those things that you've analyzed yourself. And you want that last insurance check to make sure that someone else didn't see something you didn't see. That's a good way of kind of checking into it. Like that's the, hey, am I right about this, Bob? Kind of a check, right?
Yeah.
And then they go, yeah, you're right about this. Then you go, okay. But I would not use that as like as a reason to ignore the fundamentals that you should be looking at. And if you can't examine those fundamentals yourself, then I still feel like you should just not buy it. You should just buy an index. But I think if you can look at all the fundamentals and say, this is really, really cheap. And what am I missing? And then you kind of look at that as like the last checkbox before you make the purchase to make sure that you weren't out of your mind about what you're thinking, right? But I think that if you can't analyze the value of it on your own before you go to that insurance checkbox, then I don't think you should buy it. I think that most people should just buy indexes, and that most of the time they're not going to do well doing individual purchases.
Well, if you don't really enjoy the process, then indexes are great.
Yeah.
When I'm looking at a basket and I'm building a basket of companies, I've shared this with you over the years, and you guys generally both know this. I like having kind of a core basket of companies that I would like to own at any price. The price doesn't even matter. These are just strong, well-led, great companies.
Very
Produce a
profitable.
great profitable is a metric, right? Because sometimes companies are less profitable if they're investing in tooling or infrastructure or acquisitions.
Yes,
or,
but in all fairness, those companies, if they wanted to, could flip a switch.
Yeah,
and immediately be massively profitable.
Yes,
Amazon would be a great example of that.
That's absolutely right.
Right.
So there are many companies but profit is not as growth. Revenue growth is one. Profit is not the only metric that I look at. But in general,
when you describe the company, when you describe that basket of companies,
yeah. I like owning a basket of companies that I would like to own at any price. Now, there are, generally speaking, they're leaders in their class, they're leaders in their field, right? They're leaders in innovation.
And your first reaction to them
most commonly
is that,
they're household names.
Yeah, I think I think a really good measurement to decide if you think it's a good company is just play the game in your head of saying, imagine someone has unlimited resources to go head to head with them. Yeah. And your first reaction is like, even with unlimited resources, good luck. Because I don't think it's going to work out great for you, right? Yeah. Like, here's unlimited revenue and resources to you. You just can't, right? Like, just like with that, I want you to take their throne in the next 10 to 15 years with unlimited resources. And you might be like, even with unlimited resources, they might still kick the shit out of me, right? Or probably would. Or I have no idea how, even with unlimited resources, I would even try. Right? Yeah. And if that comes to mind, right, then that's a good sign that you're probably in a good space, right?
Yeah. And then of course I like bond, just generally.
Which also explains a lot why Berkshire likes Costco so much, because like good fucking luck, right? Like, the way that they hold their position in the retail world, it's so different than everyone else's, and it's like, it could be growth in retail sectors and other places, and never do you ever feel like, oh, with the rise of Amazon and online ordering, are people going to not fucking wait in line all day long to get to a fucking Costco and not renew their membership? And the answer is like, no, they're still going to do that shit. Yeah. They're still going to do that shit, right? And and it's not going away, right?
That's right.
Yeah.
So if I said, okay, you're going to buy the number one and number two in every sector, right? So there's all these different. So I said, okay, beverage, who's the number one and who's the number two?
Coke and Pepsi. Yep. And it's always in the top two really represent how much of the market share, and especially
a lot.
Yeah, and
a lot.
What I've noticed,
those two brands represent a lot.
Yeah, and what I also have learned, and this might be true for lots of industries, but I find this especially true in tech, is that you get these. It's a room. The way I describe tech is I feel like it's a room filled with 800-pound gorillas, and they all have their wall or corner that they just dominate in. Yeah. And if the other ones try to get to that wall, they're going to get crushed. Yeah. But this truth is the same the other direction, right? It's like, good luck trying to take Google's position when it came to YouTube and search engines, right? Good luck trying to take away from Microsoft when it comes to operating systems and Office, enterprise software, right? It's like, or the video, I like to try to reference the video game platform world, but there's, I think that Sony and Microsoft have done a good job entering that space, but I always get shocked how much Nintendo just finds a way.
Because you claw back.
I gotta tell you guys something though. I gotta tell you something about Nintendo that I didn't even realize, and my kids had to school me about it because it made me just respect Nintendo so much more. You know, you think I grew up playing Nintendo, and so if you say what franchises inside of Nintendo can no one ever touch, they always just do well.
Mario Brothers.
Right. That's the first thing I came up with, right?
Yeah.
Okay. Yep.
How much do you think Mario Brothers, in terms of a franchise inside Nintendo, represents their market share?
Oh,
I don't know.
in total, like 3%. It's small.
It's small.
It's like 3%.
I didn't even fucking know that they owned Pokemon.
Oh, that's a big one. Yeah, Pokemon.
No, Pokemon is like, if you actually look at the revenue that's generated from Pokemon, if Pokemon itself was its own company, dominates almost all the other companies in that same sector. I didn't even know. They did such a good job of growing that franchise. I didn't even know the affiliation. And it's exclusively a Nintendo thing.
Right.
I had no fucking clue.
Yeah.
And when I found that out, I'm like, God, not only did they do it again, but they did it on a whole different level. And they did such a good job of making it its own brand and not being affiliated that it just can get to whatever size. I almost feel like it would hurt them if they actually
correct
advertised the
me if
affiliation.
I'm wrong, but there was a big, a majority of the revenue was from data. And when they did the Pokemon stuff and they were out there finding the virtual things, really it was a data game. And it was like, okay, we're going to collect. And so they would just send the things that they wanted you to find next to the locations that they thought
The
you might be
Pokemon
interested in.
franchise is
Yeah.
worth more than the entire Star Wars,
Yeah.
MCU platforms, and all the other franchises inside of Nintendo combined. It's not even close.
It was mainly because of data, though, right? Because they had so much
I have no idea. I
intelligence.
don't play that shit.
Yeah. I don't either.
But what I
never
do
did.
know is that it's everywhere.
Yeah.
Right? Yeah. They
I'm
just
talking about the Go stuff. That's where they really hit the big data aggregate because that was where you went out to find the characters.
Yes.
Right? And you had to like hold your phone, and there was a GPS tracker, and it was like saying it knew where you were relative to restaurants you might like, and so it was a big data aggregation.
and we're like, who the fuck are these people all jumping to the same corner of the same intersection in Boston?
Walking around like this.
Like there's a bunch of
And
Asian
finding-
kids in this intersection at Boston with their phones out. Like, what are they doing, right? And yeah,
funny.
but I got to give them the credit in that space. But typically, to come back to what I was saying is that if you look at the tech space, almost every major industry that you think of, or every company you think of, massively dominates their space. And there is number one, there's number two, and then there's last. Right?
Yep.
Like, it doesn't matter if you're third, fourth, or fifth. If you're third, fourth, or fifth, you might as well be last because you're a sinking ship. You need to find your way to get to the top two in that sector or just stop. And they're all, every time there's a new sector that comes out, they all try to see who can vie to become that top two in that space. You know, phones, it's going to be your Google and your iPhone. It's not even close, right? And Apple dominates that space on a huge scale, even above Google. Who's third? Doesn't even matter. Might as well be last, right? Yeah. I mean, in search engine space, I don't even know if 2 or 3 even matters anymore. I think that number one is the only one that really matters anymore.
Well, where 2 and 3 are now are like ChatGPT, these other AI platforms that they are trying to move into search. That's what
that actually makes a lot of sense.
that's
Yep.
what the new, but that's also where Google still wins because they have. If you guys use Google, their top result now is just their AI generated answer.
Yep.
Right? It's not a link. It's just the
And good for
answer.
them for investing so much in that space because if they didn't
Yeah.
realize that was there, then they could lose out their
For
position,
sure.
right?
Yep. So, all right. Okay. Let's wrap it up.
Yeah.
I want to wrap it up with a question, not related to this at all. I'm just curious, since it's the first day of the second quarter, what is one thing that you're working on in Q2? What is an area of emphasis? How are you going to know if it's a successful Q2 for you?
I mean, my answers are always boring. I got a list of things.
They're not boring. What's the high up there? Like, what are you focusing on this quarter? Like, it can be more of the same, but like, what, are you trying to get anything done?
People are surprised to hear this, and this is not a confidence question in my portfolio, but I'm actually looking to unload parts of my real estate portfolio, and it's not because I don't think that they're not going to do great next couple of years. I think that everything I own is in a great position and will do great, but it probably has to do more with my own personal position. than it is where I believe things to be.
Yeah,
and
we're rebalancing probably kind
yeah,
of, right?
a lot of it's
Personal
like
rebalance.
Yeah, look, I got a lot of fucking properties, and the new zoning changes have came out for a lot of my areas. And if my portfolio was static, where I didn't think that there was these zoning changes happening, then my portfolio represents what it is right now, without me touching any of it, represents something that if I just hold on to it for 8 to 15 years and trade it in, is going to be exactly what I want. But what I also recognize is that I've actually have way more than what I need when I consider all of the land that I own that I can now develop that was not on the table before. Land that I just didn't look at
New
before.
opportunities, basically.
It's already in my portfolio, right. But it just wasn't the zoning laws were not in place, and I knew those changes were coming. I just needed to see them get kind of finalized.
Yeah.
And so for like a lot of it was like I have a qualified opportunity fund. I have this acre lot that's on the lake, and the city told me I couldn't develop it, right? And I could probably put another 12, 15 units based on the land size. And I needed to kind of see them just, because even I know how the government works. It's like the state can tell them they have to mandate it, and then they have to take and translate it. But you don't want to get into a fight with them and tell them you did it wrong.
Correct.
You want to see they officially had done it. So CTAC had officially done that.
Let somebody else do that, basically.
Yeah, like this. Let me just see that you actually did what you're supposed to do, and then I'll invest into that. And so, that city specifically, because I have so much land there, and then I've seen the draft of what's coming for the city of Seattle. Told me, you don't need to hold on to as much as you have. A lot of my positions, they have a good equity position, but the debt service is kind of high, and I paid a premium for the asset, and there's a lot of equity to be made on it. And I thought, okay, this is a good time to probably get ready to move on from it. So I want to move on from a couple of my properties and liquidate a little bit. My cash flow position will be better. My dry powder will get better. Some of it will get reinvested into the land I already have. And it's a commitment to kind of say, hey, it's okay to let go of some of. I mean, because for instance, specifically the highest value rental property in my portfolio is on the list. And it's kind of sad because I look at it and I'm like, hey, if I want to modify that house, it could be my retirement home. But I also realize you got fucking 30 rentals and what looks like to be somewhere around like 13 to 14 buildable lots that are free and clear right now. You can just buy whatever the fuck you want in your retirement home when the time comes. So who gives a shit? Unload it, lighten up the load, get a little more dry powder, get your cash flow a little bit better, and then just buy whatever the fuck you want later on, right? And so that I've needed a little time to kind of absorb that, and so that's going to be on my list for this quarter.
Yeah, love it. What about you?
So 2025 is a planning year, and everything else comes out of planning. And I mean this not just for the practice itself, but for clients, right? So every key metric, whether it's net flows or protection or assets under management or any of the metrics that a wealth management firm is going to be measured by, at least in our firm, grows and has really favorable results when you really engage in planning. And it's probably the biggest differentiator in our business, is because we do really interesting, innovative planning. And we can forecast and predict and anticipate, future outcomes, and then the rest kind of takes care of itself. So we have really an emphasis on planning, and what comes with that is not all these other things that are positively impacted, but also the net effect is that where risk shows up in our industry from a firm level is when too much of your revenues come from one sector or another. And so there's an initiative to drive recurring revenue, just like there is in corporate America, right? And recurring revenues are, we're now 5.5 years in. So recurring revenues are now at 71%. And, we want to get that number right. So we want to continue to make progress. So the goal is going to be to get that number to 80% by the end of the summer. And so that once you know where you're going to be at the beginning of every month, everything gets a little bit, easier. And so we're on this wonderful kind of trend. Recurring revenues are continuing to grow, and it's really a result of an emphasis of planning. So in the latter half of last year, we really started emphasizing planning and the importance of it because it gives clarity, and there are all these other intangible benefits that come from it. But it really is the area that we kind of shine the most, because it's where we end up having kind of the most meaningful conversations with people instead of just, what companies to buy or sell, or, what insurance to buy or sell, right? It's
Everything,
really
all those
more
small
meaningful.
decisions are so much easier to answer for people when you understand better long term.
Yeah, their priorities, and so that all begins with planning. So planning is kind of the cornerstone for everything. And so this planning initiative that we have, it doesn't just positively affect all of these other things. It leads to deeper, more meaningful relationships. Now, we've been doing this. To be fair, we've had kind of this increased emphasis on planning over the last 4 or 5 years, but it's always been kind of one of the pillars, not the pillar that leads to all the other decisions. And so, we just made the commitment that it's the pillar, and then all of these other wonderful things come as a byproduct of it. It allows us to more align everything else appropriately. And so what it requires is you to slow down. The beginning process, the first 2 to 3 months is slower, but then all of the other work is better. So Q2 is really just more continuing this effort that we really put in place in kind of the second half of last year, because it's leading to wonderful things. So that's Q2. Q2 is a focus on planning and then continuing to advance those recurring revenues. And we have very specific metrics for those.
Very nice.
How are you?
Excellent. Well, my answer is much shorter than both of your guys' answers. I basically just want to advertise a lot more. And inside of that is just devoting more time and energy to running more tests, spending more money. Like I have the people on my team for CMS and for Big Bird are both super good. So now I just want to grow, fill them up, and do a lot more advertising than I have been. So basically, essentially double my advertising budget from what it has been. And it's not it's a mental hurdle more than a financial hurdle.
Yeah.
Because we don't actually spend that much money on advertising. But when things are things have been working so good for so long, you're trying new things, you're going to experience some things that don't work out, but you can't really sort of get to the next level if you don't do that. So
Yeah.
that's what it is.
Well, it seems to me you built the infrastructure, so you have the capacity, you have the people.
Yeah.
So the infrastructure, and that's always the hardest part, because you have to build the infrastructure and the capacity before you can increase the flow. Because if you increase the flow and you don't have the capacity, then you end up having a bunch of unhappy clients.
Right.
So you build the infrastructure first, which is really where the capital expenditure comes from, and the risk is that you build the infrastructure first and then advertising second, right? So
Yes.
So now it's time to you built the capacity, so now it's time to fill it. Is that
Now it's time to go get some people. Yeah, I mean, it's been, I sort of did both at the same time.
Okay.
So
The double whammy.
well, for, CMS has been going for so long. It's
Yeah.
sort of established. All the systems and stuff have been there. It's sort of, it's just, sometimes there's a people thing that happens.
Yeah.
Like you lose a couple people and then you have to sort of reset and get new people in. For Big Bird, it's new, so it's growing, and it's me cultivating those systems and getting those dialed in with the people that I have. So they are sort of like, what's nice about starting a new business when you have an established business is you don't need the money from the new business.
Right.
Like, it's cash flow positive. It's pretty profitable at a small scale, but it doesn't really matter because not necessary to pay your bills or to,
Sure.
to do whatever you're to
Right.
eat.
Right.
So you can afford to sort of reinvest more. You can afford to hire people earlier than I definitely would have with the law firm, just because you need to eat.
Yeah.
So that's what this quarter I think is going to be about. Because I hired like 6 or 7 people in Q1. It's just like a lot of onboarding, a lot of training, a lot of trying to find recruiting, It's like, Jesus, Mary and Joseph. But hopefully that is done. I'm going to hire one more person, I think, for Big Bird, but then it's just, let's just go get some more people, some clients. So that's what Q2 is for me. So
Love
that
it.
should be fun.
I like it.
All right, let's wrap it up. This is the Business Barbershop Podcast. I'm Chris.
I'm Keen.
I am Andrew.
That's it for today. See ya.
See you guys later.
See ya.